Good everyone. I'm Mark Antonio Dagawasan, and my topics is all about activity-based cost accounting and alliance pricing strategy. Activity-based cost accounting. The activity-based cost accounting or EBC system is a method of accounting that can be used to determine the total cost of a production in developing a new product. The EBC system consists of direct and indirect cost production. Some businesses take their overhead expenses and allocate them evenly among all products. But because some products use more overhead expenses than others, the cost of making each product is inaccurate under this method. With activity-based costing, consider both the direct and overhead costs of creating each product. Recognize the different products require different indirect expenses. Activity-based costing is a process for assigning costs to activities. First, identify which activities are necessary to create a product. Then, separate each activity into its own cost pool, with its group of individual costs associated with an activity. Determine the total overhead of each cost pool. For example, purchasing could be its own cost pool. Next, assign activity cost drivers to its cost pool. Cost drivers are things that control the changes in cost. For example, purchasing costs are driven by the number of parts purchased. There are 5 steps in activity-based costing. First is identify which activities are necessary to create a product. Second is separate each activity into its own cost pool, which group individual costs associated with an activity. Third is determine the total overhead of each cost pool. For example, purchasing could be its own cost pool. Four is assign activity cost driver to its cost pool. Cost drivers are things that control the changes in cost. For example, purchasing purchasing costs are driven by the number of parts purchased. And lastly, the number 5 is divide the total overhead in each cost pool by the total cost driver to get your cost driver rate. Lastly, compute how many hours, parts, units, etc. activity use and multiply it by the cost driver rate. Next topics is about alliance pricing strategy. A strategic alliance is an arrangement between two companies to undertake a mutually beneficial project while it retains its independence. The agreement is less broader and less connection than a joint venture in which two businesses provide resources to develop a separate business entity. The alliance strategy goal is to provide organization in promoting the product while producing, advertising, and pricing strategy. The alliance band create much higher profit for both firms compared to the non-cooperation. This, this is expected as alliance band management is the first best solution. The strategic alliance, both firms would price their products higher than they would under the competitive settings. The firm's profit margins will increase from the scenario of non-coordination to that of coordination. An organization may enter into a strategic alliance to increase into a new market, improve its product line, or develop a competitive advantage over a competitor. The arrangement allows two businesses to work toward a common goal that will benefit both. It may be short or long term, and the agreement may be formal or informal. The alliance band produces a higher profit for both firms compared to the case of non-cooperation. And that's all the activity-based costing accounting and the alliance pricing strategy. Thank you.